Jim Bianco, someone to synthesize all this with us from Bianco Research. Jim Bianco, can we get back to Dow 14,000 sooner than a lot of the strategists are looking at, or certainly sooner than the gloom crowd is looking at?
Can we get back there sooner? Yeah, we can always get back there sooner, but I don't hold out hope that we will. Market's got a lot of headwinds that it's going to have to overcome in order to get back to the all-time highs, the least of which is, can it survive at these levels without quantitative easing, without money printing? That's been, I think, helping to support the rally since last summer.
The Federal Reserve Bank of San Francisco put out a paper yesterday really saying that quantitative easing 1 or 2 had little to do with commodity prices going up. Do you agree with that?
Not entirely. I do understand their argument that commodity prices have their own supply and demand curves that have been pushing them up, that there has been unrest in the Middle East that's pushed crude oil prices over $100. But I do think quantitative easing has been an inspiration for the massive record speculation that we've seen in a lot of these commodities on the long side. If you look at the Commitment of Traders report, up and down the line, you see nothing but just record amounts of longs in all kind of commodities, from agriculturals to soft to energy.
Let's look at dreaded first chart first. Where are the blue chips? I mean, up we go in the market. Climbing, Doug Cass has been very good on this. There's just a huge wall of where we've climbed. This from Jason Trenner. Jim Bianco, it's the NASDAQ 100, reformulated today a la Apple, and the S&P 500. We're comparing them, and you can see that NASDAQ boom versus the S&P 500, and then it's been a very gradual move. Where do you want to be if you have to be in equities? Do you want to be in the Colgate-Palmolives of the world, or do you want to be in the national semiconductors?
I think that if you want to be in equities for a longer period of time, you probably want to stay in the staple big cap stocks. Those are the ones that are benefiting the most. Now, if you asked where are you going to find individual stock opportunities, you're probably going to find those in the NASDAQ. But if the question is, do I own the spiders or do I own the triple cubes, I'll take the spiders at this point. I think that they will probably have a better upside potential as we move forward from here.
So how much do you have in the equity market? If you're that cautious on the release, the finality of QE2, are you 0% or do you shade it?
No, I actually think that between now and summer that the equity market continue to move higher. And then once we get into summer, there's going to be talk of QE3. Whether or not James Bullard of the St. Louis Fed or Ben Bernanke want to say otherwise, I think the market's going to wish or hope for QE3. That'll keep the market up for the next few months. The big question is going to be is if we get inflation to return or the fear of inflation. That's the game changer that changes everything. I do think we probably see that by the end of the year. So if you're aggressive, I'd be long the market now until the middle of the summer. If you're a little less aggressive, I'd probably have a neutral position on it. I wouldn't underweight the market or short it until much later in the year.
Bring up this chart, folks. We showed this with Al Broadus the other day. Bianco considers equities in the end of QE2, and Jim, it's just the asset expansion of the Fed's balance sheet, way out over $2 trillion. Can they manage this in a smooth enough way not to give an abrupt shock to equities? If Ben Bernanke in a press conference, or Ben Bernanke at the Economic Club of New York, or Ben Bernanke in Stone Mountain says restrictive, in the 28 flavors you can say restrictive, isn't that going to make the market drop the next day 642 points?
It might. I mean, that is going to be the big high wire act for the Fed. Once they decide to end QE2, now I know that they'll try to say, but we're not going to be restrictive initially, so it won't hurt. But we've got $2 trillion of excess reserves that's going to have to come out of the market. And as I mentioned before, the wild card is going to be inflation. As long as the perception is there is no inflation, gives them a lot more latitude in how to manage this. But if inflation is perceived to have come back, then the market's going to demand get rid of all this excess liquidity right away. Well, there's too much to get rid of right away, and that's going to cause a lot of instability in the market. So it's a high wire act that is yet to be played out and probably begin later this year to see how the Fed handles all of this liquidity.
New York, here's what I'm watching, gold to 1450. This is the chart I wanted in the end paper of my book like 4 or 5 years ago. This is inflation adjusted gold. Thanks to David Malpass for this, and up we go near 1450 per ounce. This rise from the beginning of the decade, the beginning of a decade. You can see it there. Let's go over to the screen. The Fed doesn't care about gold gold. There it is. It's a 30-day chart here on the screen, and up we go. 1450.50 intraday, 1450.50. Byron Wien has been brilliant on this. Jim Bianco with us from Bianco Research. Jim Bianco, what do you do with gold here?
You buy it. I think it's going to continue to go higher. Think of it as the closest thing you have to getting your money out of the financial system. And with record amounts of speculation and money printing, you might want to get some of your money out of the financial system, and it goes higher. Also, remember, gold doesn't really have a valuation to it. Can gold be overvalued? That's hard to say. It moves more on psychological factors. And as long as we have quantitative easing, and don't forget the Bank of Japan, with the massive amount of easing that they've done since the earthquake, I think the path of least resistance for gold is higher.
Jim, when you look at this, and I could say, okay, fine, gold, great. There's a lot of cash out there. We saw Texas Instruments just deploy a modest amount of cash yesterday. Doesn't the optimism of Texas Instruments push against the gloom of gold?
It does, but I don't think it's enough to offset it. If you were to draw it larger and look at the larger M&A boom, and Bloomberg has a bunch of statistics on the amount of M&A announced every day, it's running at around half or two-thirds the levels that it was running in 2007, 2008. Admittedly, they were a little bit bubble periods, but we're nowhere near back to the LBO craze that we had 3 or 4 years ago. So, yes, Texas Instruments is bullish, but the overall level of M&A activity suggests that there's not really a lot of optimism out there. There's some, but there really isn't a lot of giddiness that would offset the rally in gold.
You'll hear me talk about, folks, a jump condition. Boy, did we see that. We'll show this with Sean later in the hour. A jump condition, National Semiconductor. I mean, Jim, any way you look at this, look over there on the right side of the chart. Victor, you got to show that hockey stick, that right angle, as Ben Bernanke would call it, over on the right side, that fine yellow line against the white border. That's that premium for National Semiconductor. Jim Bianco, somebody out there is finding value against the gloom of the budget, the gloom of gold. Once again, corporate money goes to work.
That's correct. And we've got the market at a 2-year high. And the question you have to ask yourself is it prices or is it value? You're right that National Semi and Texas Instruments see value there in putting together a deal with a gigantic 74% premium. But Ben Bernanke doesn't see value. Ben Bernanke sees prices, and that's why I think he's doing QE2. He's pushing prices higher and taking full credit, I might add, for the rally in stocks, as he has on a number of occasions. And when you start talking about prices, then you start talking about markets being at the wrong place, and that's a little worrisome. Like I said before, QE2 is not going away for a few more months. There'll be talk of QE3. The market can continue to move higher in that perspective. But after that, we'll have to ask the question is whether or not the values are there to hold the S&P at 1350 or 1400, which is where I think we might wind up being before all is said and done, or if this has just been a big money printing exercise that's put it up here.
Let's get the financials up here. Diamond and Blankfein outperformed the KBW Bank Index. I hate to personalize it, but you can't help it when you're in the media. Diamond and Blankfein outperformed the Keefe, Bruyette and Woods Bank Index. The yellow line there underperforming, and you can see JP Morgan and GS normalized back to 2005, back to a happier time. Jim Bianco, what will the financials do given this polarity between the M&A activity of Texas Instruments and some of the caution and gloom you see out there in the economy?
I think that if framed in that discussion, the financials will do very well because it'll keep the yield curve very steep. Remember, at the end of the day, financials are a large carry trade. They borrow at the short end of the curve. They invest at the long end of the curve. As long as it's very steep, they make money. What's going to hurt financials would be the continuation of the rise in the front end of the yield curve. What we've seen with 2-year notes moving up 20 or 30 basis points in the last couple of weeks. What gets that going is the end of QE2, the perception that the Fed is going to tighten, rates go up, that would hurt financials, but we don't have that condition right now.
What Jim just said, folks, is really, really important. The front end of the curve, that's 0 to like 2 years. Where's the front end? 2 years?
Yeah, that's usually the accepted wisdom on it, although some people would differ on it.
Okay, hands, 2-year yield here. 10-year yield here. There's a difference in yield. That's a spread in the 2 years coming up. At what point, critical question, Jim Bianco, if the 2-year yield is, this is going to be a future advertisement. If the 2-year yield is here, what point does that 2-year yield become painful and signal that the carry game is over for the big banks? Is it 1%?
It might be 1%, but I think, following on, it's more of a where is it in relation to the 2-year note. If it gets less than 1.5% below the 2-year note, and it's been as much as 3 and well over 3, then that would start to signal that there's going to be some squeezing in the yield curve, that borrowing at the short end, lending at the long end, doesn't yield as much profit as it used to. So I think it's if the yield curve gets inside what we would call 150 basis points or 1.5%, then you'd really have to have a question in your mind as to whether or not the banks are going to be viable, or at least viable at these valuations.
Let's talk about the big bank, the United States of America. We showed this chart the last couple of days. Thanks for the emails and the Facebook comments on this. In search of the limit, sounds like an Eagles song. In search of the limit, and you've got here total debt to GDP pushing out at 14 trillion. We're working on a mathy chart, semi-log per capita. Marvin just fell off his chair running the camera when I said that. Jim Bianco, total debt to GDP. We're not on the edge of Japan, but this is getting serious, isn't it?
Yeah, it's getting serious also if you think about what did we just go through, a financial crisis. What did we say we were doing during the financial crisis? Deleveraging. And what does your chart show? We didn't deleverage. We switched around the leveraging. Yes, the private sector borrowed less, corporations borrowed less, but the government more than made up with it, so that debt continues to expand. And it is going to be problematic as we move forward from here, especially if we continue to run big budget deficits. That may not be a problem for 2011 or may not be a problem for 2012, but it will be a problem somewhere down the road, and it needs to be addressed now when it's easier rather than later when it gets more difficult.
Final question, Jim Bianco, Cubs or White Sox? Who looks good this year?
No, the White Sox look good this year. The Cubs, we're already on to wait till next year, and we haven't even paid our taxes.
That sounds good. Let's leave it there. Jim Bianco.